Now, I'm going to discuss about institutional financing. There are various kinds of institutes which are providing finances to business organization. Different kind of units according to size and nature of business, they demand for finances, and these financial requirements are met through different institutions. First of all, I'm going to discuss about State Financial Corporation. It is established to meet the financial requirements of small scale, medium scale industries. There was a need of special financial institutions like the central government passed the State Financial Corporation Act on 28 September 1951, which empowered state government to establish financial corporation to operate within the state. So far, many financial corporations have been established in different states with the objective of establishing uniformity in regional industries, provide incentive to new industries, bring more and more efficiency to regional industrial units, to provide finance to small scale and medium scale cottage industries in the state, and develop regional financial resources. There are certain restrictions on the provision of functions. It is not to accept deposits exceeding the paid up capital and not to give loan on the security on its shares and not to declare dividend on its shares without the sanction of central government and not to purchase shares and stock directly of an industrial unit or a limited public company. There are various financial resources for this state financial corporation. Share capital is one of the resources, and the shares, bonds and debentures is the one of the state financial corporation resources. Public deposits are the resource, and other resources like borrowings from government and Reserve Bank. State financial corporations, they are not working in accordance with the financial needs of small scale and medium scale cottage industries. It is a critically evaluated, and main undue delay in sanctioning or disbursement of loans and absence of financial technical experts and speed of progress is quite very low and complex in working of shortage of requisite capital, and difference between the loan sanctioned and disbursed is quite large. So lack of training facilities to employees, and lastly inadequate underwriting. Second institute is Industrial Finance Corporation of India Limited, or IFCL. The Industrial Finance Corporation of India was established in July 1948 under the Act of Industrial Finance Corporation Act 1948 to provide financial assistance to medium and long term to larger scale industries all over the country. On 1st July 1997, the name of Industrial Finance Corporation was changed to Industrial Finance Corporation of India Limited. The main objective of this institution is to provide financial assistance to large-scale industrial units, particularly at time and when the normal banking accommodation is inadequate and not forthcoming to assist these industrial units. Industrial enterprises organized on the basis of proprietary or private limited companies basis cannot take loans from this corporation. So only public limited companies are eligible to take loans from it. Its management is by board of directors consisting 13 members in all, both nominated and elected. Head of the board of directors is called chairman, appointed by central government with the consultation of board of directors for a period of 3 years only. Besides the board of directors, there is also a central committee consisting of 5 members in all, including president. The main sources are share capital, debentures, loans, public deposits, reserve fund, and foreign currency loans. Corporation can accept loans in foreign currency with the prior approval of central government, such as loans from international bank and other international financial institutions. There it is also critically evaluated on the basis of nepotism and favoritism in granting loans. Undue preference of well-established large business enterprises, overlooking interests of the small business on development in backward regions, they are almost ignored. Granting loans to business unit not covered by 5-year plans and overlooking interests of small business and development, delay in sanctioning loans, a very high rate of interest. Most of the loans sanctioned to those industrial units which are already organized and financially strong. So the corporation has failed in regional and territorial economic development. The assistance is insignificant as compared to the requirement of industrial units, and hence it has knocked at the doors of other financial institutions. The recurring expense is also very high. Next institution is Industrial Development Bank of India, IDBI. The Industrial Development Bank of India was established on 1st July 1964 as an apex bank. The counterpart was Reserve Bank in the field of industrial finance and capital market. It was delinked from Reserve Bank on 16 February 1976 and was given a separate independent entity under the central government. So, the objective of this apex institution is to coordinate, supplement and integrate the activities of existing specialized financial institutions. It is a refinancing, rediscounting institution operating in the capital market to refinance term loans and export credits. So it is the charge of conducting techno-economic studies. It offers loans for the purpose of not merely on security of property as mortgage or pledge. It was expected to fulfill the needs of rapid industrialization. So in the beginning it was subsidiary of Reserve Bank of India. Both had common board of directors. Then later it has been delinked from RBI and it is an independent board representing the government, commercial banks, financial institutions and industries. The sources are share capital, bonds, loans from central government, loan from Reserve Bank, loan from foreign currency, reserve fund and other resources which include public deposits and grants. The management is by board of directors and maximum number of directors is 22. At present there are only 18 directors in the board. The head office of IDBI is situated in Mumbai 5 regional offices are situated in New Delhi, Calcutta, Chennai, Guwahati. Besides regional office, IDBI has 20 branch offices situated in different parts of the country. IDBI is playing a dynamic role in promoting the growth of industries as an innovator in the area of industrial finance. So financial resources are being diverted into socially more desirable channels. Emphasis is being given on assistance to small and new entrepreneurs and units located in underdeveloped regions of the country. IDBI is a major source of industrial finance. Refinance of export credit is offered at lower rate of interest. In the field of export financing, it was acting as an export bank. It is due to the fact IDBI is an apex bank in the world of industrial finance, and it must be primarily as a residual lender of last resort and filling up the gap in industrial finance which are left out by other financial institutions. Unit Trust of India. It was established on 1st February 1964 under Unit Trust of India Act by the Government of India. It has been established as a landmark in the history of investment trust in India. The objective is to offer both small and large investors the means of acquiring shares in a widening prosperity resulting from steady industrial growth of the country. There are two primary objectives of Unit Trust of India: to promote and pool small savings from the lower and middle income group people who cannot have direct access to the stock exchange, to give them opportunity to share the benefits and fruits of prosperity resulting from rapid industrialization in India. The main focus on convert of the small saving into industrial finance and give them opportunity to share the benefits of industrialization are the main objectives of this Unit Trust of India. The main finances resources are capital, share capital, then sale of units, then loans, reserve fund. Its management is by Board of Trustees consisting in all 10 members. So it has a president who is nominated by the Government of India. It has an executive trustee appointed by Reserve Bank of India. Among 8 members, 4 members are nominated by Industrial Development Bank of India, 1 nominated by Reserve Bank of India, 1 nominated by Life Insurance Corporation of India, and remaining 2 selected by the investment institutions. The head office is in Mumbai and 4 regional offices situated in Delhi, Calcutta, Mumbai and Chennai. Besides above, the Unit Trust of India has 10 branch offices situated in different parts of the country. It has been critically evaluated because lack of transparency in its operations, and Unit Trust of India has been manipulated by vested interests of the effect that transactions on the stock exchange. So, it has been accused of corruption at various levels. Investors do not possess the right to attend the annual general meeting. The expense ratio of the Unit Trust of India is quite high. Investors do not get benefits of the capital appreciation on the investments made by them. Pricing policy is open for criticism. Operations fall much short of the standards of expectancy. Investors are not getting adequate return on their investment. In spite of the criticism, Unit Trust of India emerged as a leading financial institution in India. So it has been successful in propagating the unit culture of the country and offered alternative lucrative channels of investment to small savers. Now, Industrial Credit and Investment Corporation of India, or ICICI. It was established in India on 5th January 1955 to assist industrial units in private sector. It was sponsored by the World Bank. The objectives are to assist industrial units of the private sector and to assist in the creation, expansion, modernization of industrial units in the private sector, encourage the inflow of participation of foreign capital in private sector of industrial unit, to expand the investment market in India. The management is by 11 directors, out of whom 7 directors are elected by Indian shareholders, 2 by British shareholders, 1 by American shareholder, and remaining 1 nominated by Government of India. It has a full-time chairman and a general manager. Financial resources are share capital as usual, loans, and it is the ICICI. It has made commendable record of assistance to industrial units in private sector, and main industries getting financial assistance from ICICI include paper, pulp, chemicals, electrical equipments, automobiles, cycles, machinery, manufacturing industries, cotton textiles, sugar, cement, and assistance has also been provided in the form of rupee loans, foreign currency loans, guarantees, underwriting, direct subscription to securities, and the performance of merchant banking division of ICICI is excellent. So a review of financial assistance sanctioned by ICICI has really doing commendable job, but it has been also criticized in spite of the progress by different economists. So ICICI adopted an indifferent attitude towards providing assistance to backward regions of the country. The gap between loans sanctioned and disbursed is quite wide. It has failed to take necessary interest in the development of rural economy. But overall performance of ICICI financing the private sector industrial units is commendable, and it has started taking interest in economic development of rural and backward areas of our country. The future of ICICI is quite bright in India. Thank you.